Traders Corner is proudly brought to you by IG, the specialists in CFD trading.
Welcome back. You're watching Traders Corner, and as always, I'm joined by Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, I know you want to start by looking at the S&P 500 index, which, as you point out, is the most important index in the world, and markets have been chugging along quite nicely. Do you think there's more to be had?
Yeah, well, I want to look at this chart because you're right. It is the biggest equity market index in the world that we follow, being the biggest or the top 500 companies on the US markets. And what's quite interesting here is that these markets haven't really made much headway during 2015 yet, these US markets. They're up very slightly, but not much. And if you look at the chart that's on the screen at the moment, what you can see is that it's been gradually grinding higher over the last 2 months or so. But what's quite evident is that there's actually what is an ascending triangle pattern over here. Now, I've been a bit skeptical about this pattern over recent weeks, mainly because it's been heading right into the apex of that pattern. And often if they get too far into the apex like this one has, then sometimes they just don't play out. But nevertheless, what's actually happened is that the S&P 500 has now broken out above 2120. Which is the big overhead resistance that we've seen through February, March, and April on this market. So technically speaking, that is actually a very bullish break, and we need to respect that whilst it's above 2120. If it comes back and it fails, well, then we might have to reassess that. But as things stand right now, it's broken through that resistance, which is a bullish break. It puts the S&P 500 at an all-time high, and it does point the way for further gains on this market. I
mean, when you talk about respecting that, even if you disagree with the fact that it has broken above that point, or if you think the market is overvalued, you're saying trade what you see.
Trade what you see, and what we see there is a market breaking to new all-time highs. It's had to do quite a lot of work to break through that resistance level. I mean, you can see how many times the market has tested that level. 1, 2, 3, 4, 5 times, possibly even more if you go and drill into the intraday data. So that 2120 level is a very big level on the S&P 500. And the fact that the market has now managed to find the energy to push through that level is significant. And yes, trade what you see.
And what we see at home, because I know if you look at what's happening on the all-share, or rather the top 40 index, you talk about a level of resistance that's now possibly becoming support for the market.
Yes, that's it. So we look at the top 40 index here as we do each week, and what's very clear is that we've got that big area of overhead resistance that was at 47,200. The market broke out through that resistance in April, and it's now pulled back to retest that zone as support over the last couple of weeks or so, and it's bounced back up off that level. So as things stand right now, we need to respect the fact that this market is holding that support level, and whilst it remains above 47,200, we need to maintain a bullish outlook for our market. Yes, it might be choppy. Typically these winter months are choppy months in our market, so maybe we're not going to just go screaming higher, but we might be choppy and what have you. But provided we hold that 47,200 support, I think we need to respect the fact that the uptrend is well intact and the market still looks pretty healthy.
Well, for those who missed the show last week, and including myself, I know you want to have a quick update on that option structure that you put on, which is to take advantage of a rise in the market. Normally, the option structures that you've put on for the portfolio, and there are 2 at the moment, have been to take advantage if the market falls. So now you're just covered on all bases.
Yes, well, that's right. So I'm covered on all bases. Last week, we did a very complex show where we looked at the 2 option structures that I've done for this June closeout period, and then I went long of some IG markets, top 40 CFDs against that option structure. So it's very complex, but basically to summarize it and to simplify it, the payoff profile of the structure looks like that, as you see on the screen now. So it looks like mountains, I suppose, if you green mountains. But nevertheless, what's nice about that is it actually gives us upside participation now, irrespective of where the market goes from here. If the market goes higher, we make money. If the market goes lower, we'll make money. Where we sit right now is at around about 48,400 on the top 40 index. So you can see it illustrated there with that orange dotted line. And that payoff profile is as it would look on the closeout on the 18th of June, so a month away from now. And you can see if the market goes lower, we'll make some money. If the market moves higher, we'll make a bit of money. So we kind of are covered on all fronts. And what I said on last week's show was that I wasn't really sure whether this market was going higher or lower. And given that we're going into this choppy time of the year, that's quite a comfortable place to be,
Sure.
knowing that we'll make a bit of money irrespective of what happens from here.
Although you hope it doesn't close at 49,000, because that seems to be where you'll make the least.
Yeah, that's where we'll make the least, but we'll still make something. But yes, I mean, obviously you're right. Somewhere to the left or right of 49,000 is where we would look for the market ideally to go, so that we can make a bit more money than the 2,000 rand that we would come away with at 49,000, which hardly seems worth the effort.
Yeah, I don't want to say Murphy's Law or anything like that, but we'll wait for what happens in June.
Yeah.
But guys, in the context of all of this, and so kind of the bigger picture stuff, you've gone long on one particular share this week, and it's Capitec. Tell us why.
Yes, it's Capitec. And in this type of market environment where I'm expecting it to be a bit choppy and a little bit, maybe a bit directionless, it's nice to be patient and look for special situations to trade. And Capitec really gave us a very nice opportunity of a special situation last week. So I'll spell it out for you. I mean, that there is a 1-year chart of Capitec. And you can see that undoubtedly that's a very strong rising trend. I mean, that stock's nearly tripled in value in the space of a year. It's just been a phenomenal performer. Now, recently, or last week Wednesday, in fact, there was an announcement that came out that the PIC, the Public Investment Corporation, had concluded a book build to sell 5 billion rand worth of Capitec shares through an accelerated book build process. Now, we've covered these things on the show before, but typically the way it works is you've got a large shareholder like that looks to offload a large block of stock into the market. They will go to a couple of investment banks and say to them, right, you need to find us buyers for this stock, please. And because it's a large line of stock and they need to place it, that line of stock typically gets placed at a discount to the prevailing market price. And you can see it now, that area that I've zoomed in on there with the little box, I'm going to zoom in there, that's effectively the last 2 months worth of trading action.
Okay.
Now what happened here, and this was last week Wednesday, you can see that the share price gapped down on the open. It had been trading at 540 Rand on the previous day, and it gapped all the way down to about 510 Rand. So it lost sort of 6 or 7% on the day when that book build announcement was made. And that's because there's a short-term oversupply of stock in the market, given that this big seller has offloaded all of this stock to institutions. And typically, that's the exact reaction that you expect to see. The share price gaps down, it trades down towards the book build price, which in this case was at 505 Rand per share. And you can see the huge volume spike illustrated over there on the volume graph at the bottom there. So that illustrates that more than 10 million shares traded or changed hands on that particular day, coupled with the fact that we had this big gap down in the share price.
Yeah.
Now, the reality is, this is caused by the fact that there's a short-term oversupply of shares in the market. The company has not changed one bit. It's still the same business, it's still the same earnings, it's still the same everything. It's just that you've got this short-term market dynamic which has come along and upset the apple cart slightly because there's an oversupply of shares. And typically these things do correct themselves fairly quickly. So we look to take advantage of this as a trade. And subscribers to traderscorner.co.za would have seen this as our analysis last week, Wednesday. We published this and we suggested buying. Now, I want to just zoom in a little bit more. Again, now we're going to look at an hourly graph of Capitec to illustrate even in greater detail what happened over the last couple of weeks' worth of trading action. So there you can see the big gap down on that news of the placement of the 5 billion rands worth of shares. Now, I've spoken many times on this show about the application of a 3-day rule, where something comes along to shock the market, and it typically takes about 3 days for the market to digest that, and then for the price to start to normalize, and you get a snapback reaction in the other direction. So if we have a look here, that was day 1, which was where the news of the placement happened. Day 2 was where we saw further selling pressure, further weakness in that share price. Day 3 came along, and that was where we saw some stability starting to emerge, and you can certainly see that share price moving up off the intraday lows, and in fact closing near the high of that day on day 3.
Well, I suppose, anyone who was buying shares around 550, they would have looked at this and thought, well, I'm going to be buying here because I think it's cheap.
Well, that's it. And there's a perceived bargain here. I mean, you're right, it had been trading at 540, 550 just a few days earlier. Now suddenly it's down at 510. And nothing's changed at the company, nothing whatsoever. So it is an opportunity to take advantage of an overreaction. And that's what we did. We looked to buy. So I went in and I was buying that morning of the 3rd day. And I got in at an average price of about 514 Rand and 30 cents. And then I looked to set a stop loss below the lows of that time where the market was, where the panics, well, not panic selling, because it wasn't really panic selling, but where the selling was at fever pitch. And in that instance, I look for a stop loss to be set at 507 Rand and 50 cents.
So, and you wouldn't set it at 505 Rand, say? I mean, was that rather the market price set?
Look, in this case, I wanted to effectively be covered below the recent lows. So I look at it over that 3-day period. Where did the selling reach fever pitch? And the prices started to move up off that level. So the likelihood is that it's probably not going to go below those previous lows again. So it's safe to set a stop loss below that lowest point, which in this case actually was about 508. So I just put it a little bit out the way at 507 Rand 50. And the share price has started to rebound quite nicely since then. It's trading at about 532 Rand today. So that means we're nicely in the money on this trade. One other interesting thing to note is that, and this is kind of I think it's quite fortuitous really, but we've seen this offloading of this whole line of stock by the PIC. Now, on the 3rd of June, the top 40 is going to be recalculated, and the likelihood is that Capitec is the next stock that's likely to move into the top 40 index. So you're going to see reweighting of this stock as tracker funds need to buy it to get their weighting up. So suddenly you've got this hugely oversold situation because of the book build and the offloading of that line from the PIC. And then you're going to have some pretty large buying going into the end of May, I think, given that this is likely to be included in the top 40.
Although, having said that, there was a suspicion that would be the case. So could that have accounted for the earlier buying and the earlier spike that you saw in Capitec share price, and maybe that sort of top 40 buying has taken place?
Well, possibly, but I think the tracker funds would need to wait to do their buying, because they can't, they wouldn't typically do it so far in advance.
Yeah.
They would rather do that buying very close to the time when it becomes evident that the stock is going to be included in the top 40 index.
Okay. So Garth, you've gone long the stock in greater mechanics. Will you show us the trade?
Yeah, so we went long. We bought at 514 Rand and 30 cents. My stop loss is 507 Rand 50. That means that my risk per share is 6 Rand 80. I'm risking only 1% of our account in this case, which is small, but I see large potential for upside here. So you don't need to take a big position to actually do quite well on a trade like this. 1% of our account is 3,190 Rand, as was the case then. So I take that capital risk, 3,190 Rand, I divide it by 6 Rand 80, which is our risk per share, and it gives me 469 shares. So rounding that off, I've bought 470 CFDs for our portfolio. The target I'm looking for here is 580 Rand, which is
quite steamy.
It's steamy. It was the previous high that we saw in this share price. I don't see any reason why it can't go back there, but let's see. Maybe it's ambitious, but let's see. I think there's no reason why it can't go back there. That gives us a very, very juicy risk to reward ratio then of 1 to 9.6, which is fantastic if we can get that right. And then lastly, the exposure on this trade is 241,000 Rand. That we've taken exposure to 241,000 Rands worth of Capitec CFDs.
I imagine if it does come off and it does hit that target of 580, that risk to reward ratio must be probably one of the best you would have ever put on for the portfolio. Yeah,
we've seldom had a risk to reward ratio that works out as good as that. So it is a very, very good risk to reward, assuming we can get that target. It is a possibility that I might look to exit the trade early for whatever reason, in which case it wouldn't be as good as that. But as things sit right now, that's what I'm looking for.
Okay, Garth, so what does the portfolio look like, given that you actually have been pretty busy, a lot of the option structures taking place, and then this recent trade in Capitec? Yeah,
so these are all the trades that we've got open currently. You can see the 2 option structures which have a month to run until the June futures contract expires. Then we've gone long of the IG Top 40 cash last week from 48,000. We're making some money there. We're up about 2,400 Rand there. And then this Capitec position is up 6,600 Rand for us already, given that we put this trade on last week, Wednesday. So the portfolio is up 30% for the year to date, and it's only the middle of May. So looking good.
Not too shabby.
Yeah, 326,000 Rand is what we've got in our account, and obviously we start the year with 250,000.
Yeah, so the charity portfolio is looking very promising indeed. And then Garth, to end off with your next course date.
Yeah, I've got 2 courses coming up in Johannesburg on the 4th of June and the 6th of June. I've got an understanding CFDs course and then a high probability trading course. Anybody that would like to attend either of these 2 courses, please email me, garth@traderscorner.co.za, and I'll send you the information.
Great, Garth, we'll leave it there. Thanks as always for joining us. Garth McKenzie is, of course, founder and editor of Traders Corner.
Traders Corner is proudly brought to you by IG, the specialists in CFD trading.